The Hedgeless Horseman here. It's February the 9th, 2024. I'm super tired today, but bear with me. First of all, thanks to sponsors. Let's dig in. Markets haven't opened yet, but it looks like green day in the, full go in the stock market, and natural gas is really taking a beating. Metals are, I guess, almost unchanged. Anyway, first I would just like to play this, where Rick Rule gets asked how today compares to the junior sector of 2016.
Was comparing 2016 to now.
I liked 2016 in the sense that we were 4 years into a bear market. What's better now is that then there was still hope around the juniors. People have truly thrown the speculative stocks out with the bathwater. There has been a hiatus in purchasing of the juniors now that's gone on for 12 years. And the market forgets that the juniors can go up in price. So for me, I mean, for the issuers, this is worse than 2016. Because it's worse now for the issuers, it's better for the check writers. And I'm a check writer. So I like this market better than that market.
Thank you very much.
So, I think that's an interesting point. He obviously has a few decades more of experience than me, but I remember the 2016, 2015-16 bottom, and at the time I wasn't really, I had no reference really. That's when I started buying juniors for the first time. So I didn't had to sit through the fall from 2012 or whenever it was, maybe even 2011 down there. So it's like I had no real experience, no reference point or anything like that. So it's good to hear that he was obviously more aware in 2016 what was actually happening, how hard it was for companies, etc., etc. So it's interesting to hear him say that basically we've been, in his words, in a bear market for 12 years. So it's like that kind of puts into perspective, I think, how fat the 2011 2012 top was. The bull market leading up to that this sector hasn't even recovered, and like he says, it's even worse now. It's worse now than 2016, and 2016 was the worst bear market that's ever been. But sentiment is even worse now, and sure, we're in 3 years into a bear market. So all of this leads me to believe that, and you could see that in the TSXV, it's basically flatline. So what I'm thinking is that, I see a lot of people, they say they would be happy with 100% return in the future. Given how shitty the sector has been. But all of that together, it's like, okay, if it's actually been, a 12-year bear market, and just looking at the TSXV, it's making perhaps some kind of reversed head and shoulders bottom, but it's basically flatline, like it's dead. So I'm thinking that I used to think that we would have just a 2016 run or 2020 run. You get maybe 300% or something, and that's a pop and maybe another leg down. I'm starting to get more and more bullish actually, given that it's perhaps even worse than I thought. But after listening to Rick Rule here, for example, I'm starting to think that this might be we're at around the bottoms of a 12-year-old bear market, not a 3-year-old, but a 12-year-old bear market. So I actually am. The more pessimism I see, that gets me even more exciting. So when people can barely, and it's like Rick says, people have forgotten that these juniors can go up. And that's the thing. It's like this sector, which I say all the time, I mean, it's not really rational. It's just humans doing human stuff, human emotions, because obviously the gold sector is much better than 2016. But that doesn't show up in the actual share prices. The now it's not reflecting the reality. In 2016, it probably reflected the reality, but that is just fascinating. It's like it was easier for companies to raise money in 2016 when gold was at like $1,100 and no mines actually worked really. I mean, there was no free cash flow. Than it is to raise money now with gold at 2040. I mean, think about that. That kind of tells you, because you obviously, if the fundamentals are much better and the sentiment is actually worse, that means that I mean, relative sentiment, yeah, I mean, the sentiment must be a lot worse. Because, I mean, I hope you get my idea. It's like, and that's what I guess Frank Gustra said about the greatest dislocation he has ever seen. Because you got to be really, really, really pessimistic to price juniors as they were worthless when the gold business is doing pretty okay. Very dissimilar to 2016. And like he says, I mean, for a check writer, this is, and he says basically that he hasn't really been in the market in 12 years. So he's starting to invest and, you know, go into financings in juniors right now, because he's getting better terms, I guess, than he's ever had in 12 years. So it's like that's something to pay attention to. And on that note, it's like I'm listening to pretty much all the smart money I can. I watched, I don't know how many Rick Rule interviews just this last week. Ross Beatty interviews Frank Gustra, McEwen, and that's the way I, earn my long-term returns. I do a lot of work. I try to pick up as much as I can. I mean, honestly, I think my investing process has basically gotten better every year, every single year. Even though, yes, 2016, for example, was a good year, but I started off with minus 54% in the portfolio in 2015. I would say it's like there's no similarity really from how I invested back then to how I invest nowadays. That's obviously great. If you can kind of tell that you feel like you're getting better every single year, you get, I mean, better at just theory crafting cases. It's like, okay, what are the risks here, actual risks in this junior? How should I, size my, portfolio sizing, basically. I mean, if you get a few percent better each year in a few different areas, let's say, I mean, in the long term, the compounding effects from that are huge, especially as you get better and better. So it's like, I'm getting better and better, in my opinion. And why is that? Because I obsess about this all day, every day, basically. And I watch a ton of stuff, and not only, mining related, I watch primarily value investing presentations by people who are not even investing in the mining space, but they have just a lot of common sense. So it's like, Rick Rule is kind of the master of common sense. I mean, there's a bunch of newsletter writers, there's a bunch of talking heads, or whatever. If there was one person that I would obsessively, let's say, listen to, it would be Rick Rule. He probably spits out more good advice than almost the rest of the people combined, in my opinion. There is no, let's say, surprise that he is very rich, and it's no surprise that his last theme, uranium, paid off bigly, because he had common sense and patience. Unfortunately, I didn't know much about uranium, and I don't like getting into something I don't know anything about. So that's also one area. It's like, what could I get better at? Well, actually learning more about more sectors. Because there's always going to be a sector that's deep in a bear, let's say, while others are high. So if I could, always find opportunities in any sector that was cheap, that would be great, obviously. Like, I missed the entire lithium run. I still don't know much about lithium. I have one or two lithium stocks, but they're obviously in the toilet. Actually, a pretty big position, which I don't talk about that much. And nowadays, not much is happening there, and it's like I wasn't comfortable talking too much about it because it was a bet, and it's hard for me to really explain the fundamentals. So in hindsight, I probably went deeper into that than I should, but it's hard to resist. Every single lithium company, if they made a discovery, or even drilled a hole or a soil sample, it went up 4x. I mean, that's how incredible. And that's one thing that I think people should remember, even if you didn't participate in the uranium or lithium rallies. Notice how they work. I mean, when lithium was super hot, there were gold companies that added a lithium property, and they went up like 400%. It's absolutely crazy. If you made a discovery as a gold junior, you didn't get anything for it. So just let's say a soil sample of lithium could pack on 4 times as much, or infinitely more than you could do even if you had actually potential discovery hole. So, and look at lithium now, totally in the dumpster. Nobody cares. So obviously it's like, if one understands lithium, all that, now is a much better time, I would think, to invest than close to the last top. And that's one thing I should actually work on. Get some more sectors within my circle of competence, because obviously if I'm tied to gold, I mean, thankfully gold is like dirt cheap, so it's like, in my opinion, it's a no-brainer relative to lithium anyway. I don't care if lithium has crashed. Gold juniors are just dirt cheap relative to gold, because I mean, the problem with lithium is that, yes, lithium prices has crashed. Gold hasn't crashed. It's just the gold equities that have crashed. But still, again, there's always something to get better at. It's like Rick Rule is much more of a connoisseur. It's like he goes for big deposits and like world-class deposit, almost regardless of what commodity it is. But as he says, I mean, he's attracted to the most hated sectors. That's like his main driver. Is this sector hated, or is this company with a great asset hated enough for him to invest? That's the funny part. It's like, and that's what I keep saying, that this is a ridiculous sector. I mean, he basically uses sentiment as his main driver. Okay, this sector has crashed. Okay, I'm looking in the forums, whatever. Everybody hates it. No volumes. Okay, I should be buying. And he's rich as hell, so obviously it works. But imagine that's his main weapon. Just looking for the most hated sectors. And yeah, so anyways, like, earn your returns. Do a lot of work. Try to watch as much as you can, because it's like, I see it all the time, that I might have covered something, in 4 videos just in the last month or so, and I get, the same questions sometimes, maybe mostly actually on Twitter, not on YouTube, but it's like, hey, okay, you follow me and then have no idea what I actually, let's say, I was gonna say preach. And then might, a question might come up like, just give me your best stocks or something like that. Again, that's just lazy investing, because I don't know your risk profile or anything like that. It's very hard. I mean, something that's a no-brainer to me, if you don't understand the case, then it's not obviously a no-brainer to you, and you're gonna end up making mistakes. So it's not even helpful. And there's no such thing as a guarantee anyway. Because when people ask, do you have a tip? I mean, what they're actually asking is, give me something I'm guaranteed to make money on. And it's like right away. It should be basically after they buy it, it should be going up, and it should never ever correct. Uh, and that's not how, especially this sector works. So I think people just get burned on that. But on the topic of hated sectors, so I looked in. I mean, I know Rick Rule has talked a lot about, he's liking platinum, palladium, and nickel right now because they're so hated. And I just had to look at some of the largest PGM producers, and my God, yeah, they're really they're really in the toilet. I mean, the funny thing is, like, platinum and palladium companies make silver juniors look stable. I understand why he's attracted to platinum palladium, because I mean, look at the crashes and look at the rallies. 417%, 61% crash, 444%. I mean, and we're talking what? It's like, I don't know, I was gonna say, 1.75 of a year. This rally is like a year. I mean, it's just absurd. And here you have, I mean, middle of 2018 to end of 2021, and that's not even that long. 1,000%, and then now it's down 78%. Let's look at Impala Platinum Holdings. Obviously, I don't know what they did back here. Maybe it was, a discovery or ramped up or whatever. Still, it's like 8,000%. Tops when palladium topped, goes down almost 96%, almost erased. The interesting thing about this, I mean, obviously I was gonna say, I mean, if you bought the top, you're not even back to even here, but still, like, if you bought here, you'll probably be down 93% or something. And then it would actually come back and shoot through it, because it went up 1,850%. And now it's down almost 80%. So again, this is another example of commodities being cyclical. And I read that, I think Amplats is Anglo-American. Yeah, so this is another one, up almost 1,000%. Goes down 67%, up almost 700%, goes down 89%, up 1,473%. Now it's down 77%. So it's down, I mean, in the mid-range between 75% down and 89% down. So I don't know where these platinum and palladium prices are going to bottom, or where the juniors or producers are going to bottom. But obviously we need more platinum and palladium. I think platinum had a record demand last year, actually. So it's not like they're not reflecting the fundamentals that, yes, there's no demand. But again, if Rick Rule is right that it's Russia that's hoarding platinum and palladium, they're just dumping it on the market because they need the money now. They don't care about, that it might be underpriced just 2 years from now or something like that. So this might be partially artificial, and I think again Amplats, I think that's Anglo-American. I read guidance from them, a guidance report yesterday, and they're gonna go from, I think, like 3.93 million ounces of PGMs of production 2023 to down to, I don't know if it was like 3.3 million to 3.7 million. I haven't looked at others, but that's obviously shrinking of supply, and I'm not sure why that is. And I would doubt they're not alone, given that. I mean, I think we're close to some platinum and PGM mines getting shut down. I mean, if this, especially if this persists or goes lower, so then we might actually be in for. I mean, Rick Rulis talked about this, that if you have this wording, one day, don't know when, Russia is going to run out. Or who knows, maybe the war is over, yada, yada, yada. And they will simply stop this hoarding. So the bloated supply that's just being thrown at the market, all of a sudden that might disappear. And if you have these producers, let's say they have reduced their production, or they have even shut down mines, I mean, imagine what could happen in that case. That you have like steady state supply goes down, and the artificial selling, which has pressed down the prices, goes away. Because if you didn't have that disordering by Russia, these prices should reflect more, equilibrium, more like where supply and demand meets. But if supply is boosted right now, this the prices are much lower than they should, and that's why the steady state production goes down. So, I mean, it's kind of interesting that. Well, first of all, obviously, I had no idea it was this swing. I mean, I love volatility, and just looking at this, like, I mean, you could pick whatever. I was gonna say whatever level. It's like it's not a fun ride, obviously, because I mean, even if you bought here, which would net you, I don't know, hundreds of percent, you probably are looking at a minus 50% retracement first, and then sitting. I mean, this is 2016. That's 2 years of going nowhere until it explodes. And in hindsight, like is typical, that I mean the truth is that no sector stays dirt cheap forever. So even if it took, I don't know, 5 years, I mean, it's obviously more than worth it. 5 years, I mean, if you had a 300% in 5 years, that would actually be pretty good returns. I mean, few people compound at that rate, even way more than the stock market averages over the long term. And again, if you bought even more, the cheaper it got, even higher returns. So I mean, you can really make money in any commodity sector as long as you're, I was gonna say, comfortable about now and then being down at least 50%. But it's obviously not easy, because like you could have thought this was cheap, and it actually bounced quite a bit. This is probably, what is that, like 4,000? So that's 100%. I mean, that's not bad at all. But you would have hoped it would continue like that, obviously, and instead it went down for another 10 years. So it's not super easy, obviously. But now there's at least, some kind of potential catalyst. One can see it's like Norilsk having some capital expenditures and shutting down one of their furnaces or something mid-year. Again, we don't know about Russia. Maybe they'll stop selling, and maybe some PGM miners will actually go out of business. So it's already bad. That's the thing. And if we count as always for inflation, I mean, this price here is probably, that might be like this price here or something. So it's probably more extreme than it even looks. Because inflation, if we fast forward, I mean, the inflation since 2008, I mean, that's not zero, obviously. I mean, inflation has been, for a lot of miners in labor and stuff, I mean, some of it probably gone up like 30% just in the last 3-4 years. So this might actually be akin to this kind of price level, or this kind of price level or something. I'm not saying that's the case, but and the good thing obviously is that if you find some of these, I mean, he's basically said that he's buying PGM deposits and nickel deposits, I think. The thing is, obviously, the beauty of buying cheap is that if you buy something cheap, that it's, even though we're here, it's kind of pricing in that it's down here and gonna stay like that for 5 years. I mean, how are you making a mistake? The risks are to the upside. Either it's still, either it stays worthless for like 5 years or something, or it does not stay worthless for 5 years, and might have hundreds of percent in return. So that's why I feel pretty good about having a position of Stillwater and Magna and stuff like that, because hey, I mean, I don't know much about platinum and palladium, but I can see a crash. That immediately gets me interested. That was my go-to strategy in 2015-16. I bought primarily the silver juniors, actually the silver producers and some developers that were simply down the most from their 2011 peak. That's almost all I looked at. So I would buy whatever was down the most. And some stuff, I think Endeavour Silver was down like 97%. So that felt like, I mean, I didn't feel brave for doing that. It was like, oh my god, it's gotten 97% cheaper. Well, it's gone down like 97% in value, perhaps. Or I'm not going to say that. The share price is down 97. I mean, they probably diluted and whatever, and came down from overvalued levels. But like, just to get that, contrarian Rick Rule streak in, it's like, buy whatever has crashed, because you obviously know that the next big move in platinum palladium is going to be up, because platinum palladium is down, or palladium is down like 73% or something. Could it go lower? Absolutely. But still, I mean, look at these charts, and this just confirms the cyclicality of it. With that said, obviously, and that's why I keep saying, if you've only been in the commodity sector for 3 years, like you bought in 2020, what does that say? That you might be down, let's say 50%. Does that mean you're a dipshit investor? No, 3%, 3 years is nothing. I mean, look at most of the successful funds, etc. I mean, they pretty much. I know one of the most successful funds in Sweden, for example, and that's not even commodity focused. I mean, they say in the prospectus, like, you should only put in money into our fund if you have a time frame of at least 5 years, because that's how long they think it takes for their, let's say, value to show up, for the market to be a weighing machine. So if you only are in the sector a few years, and this is actually, yeah, quite a few years actually. So it's like, this wasn't even enough. But if you held it for 1 more year, you would be break even. Another year, you would be up a lot. So it's like, how long does it take to play a full cycle? I don't know. But obviously, we would like to find the sectors where we are somewhere around here. It's like, start buying here, perhaps, and it's like buying all the way down. All you know is that we are getting closer to the next bull leg by definition. I mean, this is a specific company, so assuming they're still around. That's all we know, that every single additional down day by default takes us closer to the next bull leg. Yeah, so interesting actually, and here you can really see the cyclicality. But again, it's like 3 years is nothing in this space, doesn't say much. Anyone can make or lose money in 3 years. 5-10 years, then it's like starting to show if you're good or not, and that's going to come down to your decisions. It's not going to be the market, because again, you could have bought here, rode it down here, suffered through like 8 years, sold here or sold here, whatever, and another person recognized the same bear market, went through the same shit, recognizes it's unsustainably cheap, that either the PGM sector is going to go away, which is not going to happen, or there's going to be a bottom one day. So maybe he buys all the way down and drags down his average to, I don't know, here or something. And then he holds out even more. And sooner or later, he's going to be up a lot, and probably even worth it, despite having bought at the exact top. To make it easier for ourselves, obviously, is A, buy more the cheaper it gets, and B, don't start by buying high. But hey, I mean, it's water under the bridge. If you started in this sector in 2020 and bought high, there's nothing you can do about that except try not to do it again. That's the only thing. If you bought high, that doesn't mean you should sell low. That's just, you know, one mistake. You just compound it. That's even worse. I mean, that's the worst thing you can do. If you bought high, you can't afford to sell low. That's just how it is. So I didn't touch on this yesterday, I don't think. Line 1 Metals, they came out with well, okay, on the 7th, I put it up on the site at least, announces overnight market offering. And today we get the terms, upsized, fully subscribed for 10.5 million. Common share at 50 cents, and one full warrant at 65 for 36 months. That is, I'm gonna be honest, that's a pretty brutal financing. Full warrant at prices that's like already lower than any level in going back to, well, heck, yeah, I mean, here it touched 65, I guess. A warrant at 52-week lows, that is, for 3 years, that is pretty brutal. I don't know. I mean, they were able to raise 10.5 million, but of course that was, I mean, who knows if the, you know, terms would have been worse. So I'm not 100% sure what's going on, but obviously the ones that are putting in 10.5 million, if they thought things were really crappy and Line 1 is going to go out of business, they wouldn't get much for their warrants even, and obviously not their stock. So it's like, it's, and again, I don't know if that's what they're kind of required, that you're in this tough spot. It's like, hey, we need like, you know, 7 million or something to actually, you know, go into commercial production. Then you're obviously in a tight spot if you're talking to, well, financiers, let's say, because they know you need it really bad. So they kind of have the power. So that's not great, obviously. It's like on the, let's say, the positive side is that either this mine, the Tuvalu mine, is going to work or it won't. If it doesn't work, it doesn't matter what share price it was, because it will go to zero eventually. Doesn't matter if it was from $100 per share or $1 per share or 10 cents per share. But it's the upside that's getting more diluted than anyone would have hoped, obviously. But, okay, let's fast forward. I expect it's probably going to hit 50 cents and going to be back to 2000. The funny thing is, like, this is going to sound really weird. Line 1 has actually outperformed the sector. I mean, it's still higher than it was, you know, in the bottom. It's not by much anymore. But you know, nobody's gonna really appreciate that, and I get it. I mean, it's not fun, but that's how crap this sector is. Back here, Line 1 wasn't ready to go into production. They hadn't even found the 500 bonanza zone. So that goes back to the great dislocation. I mean, I don't know what the market cap could have been back here. What could it have been? Like 50 million? Or let's say it was around 50 million here or something. Maybe 60. I don't know. Point is, obviously they have added value. They made the high grade discovery, the 500 zone, which is like, I mean, if they mine that, there's no way they're going to lose money there. But that's not the first zone they're going to be mining. But when this was pure exploration play, went higher as soon as it turned into a more development kind of story. the narrative changed and the market stopped caring about results anymore, because now everyone was focusing on, hey, if this company is going to have a future, if they're going into production, it's the production that is being able to go into production, that's the key thing. It doesn't matter really how much exploration success you have. If you added on a bunch of debt, then you go bankrupt. You know what I mean? So that makes sense. And this is in a time where it's like COVID hit, Fiji shut down, inflation is up, so many, especially gold junior producers. I mean, West Red Lake, no, not West Red Lake. Well, that's the new company, Pure Gold. I think that's the name. I mean, they went under. Monarch kind of went under. A bunch of gold producers in Australia went under, or put their mines on care and maintenance. So it's like it's one of the shittiest times there's ever been to try and put in a mine in production. Or I think it's easing now because inflation is not ramping in the same way, and oil is down a bit and yada yada. So it probably was even worse like 1-2 years ago. But it's like when you think about it, and that's obviously out of the company's control. They couldn't predict that COVID would happen. And that's the funny part. Like sometimes I read, even more so when it was still fresh COVID. It's like, some stocks were down because of COVID, and people said, oh, shitty management or something like that. It's like, are you for real? How many do you think predicted a global pandemic? No one, basically. So that's obviously not something you can. The management should be virologists or whatever. They should know that of course there's going to be a pandemic, and it's like, why are you trying to get into production now? Don't you know that inflation is going to go up 40% something? So I mean there's a bunch of stuff like that going on. The same kind of I remember that was kind of thrown at line one. It's like, I don't fault them for having unlucky timing. That's not something they can do about. And also the context is like, basically Wall is getting taken to the woodshed today, and it's like, I understand that the terms of this financing were not good. They were not good, but it's like Wally has, I don't think they have it here. Well, I think he sold Miramore no, was it? He made 2 sales of around $1 billion. That I remember. So it's like, he has a pretty stellar track record that most people will never see in this space. So what's the odds of Wally all of a sudden becoming, totally incompetent or something like that? Not high, if you know what I mean. I mean, it's not like he had a lobotomy and all of a sudden he has no idea how the mining space works or anything like that. But that's how it is. It's like, people can't afford to have one misstep in this sector. I mean, there's a bunch of bashers in here, for example. I mean, I'm taking some flack by some names I do recognize. Do you think they would ever come into a success store and say, hey man, even in this bear market, that looks like a great call now? No, of course not. I mean, but that's how people work. That's how it is. So my point is that, let's say everybody feels like a victim, that some great injustice was done to them because things don't go as planned. It's like, are we forgetting that this is, according to Rick Rule, even worse than 2016? We had a global pandemic when they were trying to, when they started with the development. A bunch of gold juniors have already gone under. Line 1 is still in the fight, and again, according to Rick Rule, this is like the worst financing environment he has seen. I mean, worse than, maybe not that he's seen, maybe 2001, etc. was worse, but like worse than 2016. So it might be like, 30-year lows in terms of being able to raise money for this sector. So it's like, I think context matters here. I don't think that Wally just wanted to add, fine. I mean, he's the number one shareholder. There's nobody in this forum that's getting more diluted than him. I mean, depending on, if he participates and all that. I mean, the terms are so good. It's like, okay, 50 cent, 65-cent warrants. Like, I'm gonna probably shoot them a message to see if I can get in. Because again, either this works or it doesn't. If it works, in 3 years, I think it's gonna be higher than 65 cents. It's a pretty straightforward bet. If you're not in the financing and you're a holder, obviously that sucks more. So I have not decided yet what I'm gonna do, actually. Now that I've seen the terms, and it's like, because I own Line 1, especially, the HODL folios. I'm much more concentrated personally because I'm locked up in a bunch of different private placements and stuff. So yeah, I mean, the thing is, let's again be a bit, I was gonna say realistic. It's like, did anybody want to see this? No. I think the previous financing back here, that was also, pretty lackluster. This is even worse, I would say. But the times are worse as well. So that goes with that. And again, if they are at a junction where, like, okay, we need, like, I don't know, $7 million. And I think Wall is pretty cautious. He does not want, obviously, line 1 to, go bankrupt or anything like that. So I think if he believes, it gets even close to having the money to go into production, whatever, I think, he's going to raise money. I think he's quite conservative in that sense. And that might, again, be, that might be one of the reasons why the terms are so favorable for the financiers. Or they really need the money right now. That it's like, okay, we have a bit of a cost overrun or something, and you don't want to shut down everything because now you're just, with debt and no production. So that's the thing as well. But yeah, I mean, it's gonna be pretty. I mean, I expect it to go down to 50 cents today. But then the question is, okay, where do we go from here? So we're gonna go down, I think, here. Where do we go from here? That is the question. I don't know. If they make Tuvalu work, this might be the low. I mean, if they go into production, they're able to show cash flow, etc. The low might be in today. If they fail getting into production, or it takes a long time to get profitable or whatever, it can go lower. If they totally fail, they can obviously go bankrupt. So we know where the downside is. That's always 100%. Question is, what are the odds of them getting this into production and being, cash flow positive sometime in the future? And of course, the spectrum is huge because we don't know the gold price, we don't know the sentiment, we don't know the gold price in a month from now, we don't know the sentiment in a month from now. For all we know, in a year, gold could be at 1,800 or 2,500, sentiment great, and line 1 at $2 or something, $3-4. Nobody knows that. That's where the risk reward comes in. So I haven't fully decided because it's not that I, like always, it's not in a vacuum. Is Lion 1 a buy, a sell, or a hold, or whatever? You shouldn't really have holds anyway. It's all relative. Especially for me, since I'm, always all in. Do I sell something that I think is less, let's say, cheap than line 1 will be at 50 cents? If I get into the placement, for example, that's a totally different ball game. If you get 3-year warrants, obviously that's risk-free additional upside. I mean, that's like, yeah, well, I mean, depending on where the stock goes and all that, but like in 3 years, you almost have twice the upside. So you need even less, put a less, lower probability of the, chance of success, and it could still be worth it. So that's one thing to consider, obviously. So this was one of the HODL portfolios yesterday. I simply ordered it in like the biggest downwashes. One was Tectonic, down 38%. I talked about that in the last video. And line 1. I'm actually up on Tectonic still in this portfolio because I think I hoovered up quite a bit at like 5-6 cents. Well, on average, maybe what like 6 cents, something like that. Haven't done anything there yet either. It's like I'm not 100% sure how I do what I do there. I don't think I'll be selling at least, because they gonna need a financing and all that. But of course, the position itself has gone down as well. So it's not that big of a deal, if you know what I mean. Line 1, then I'm actually down 30% in this one, and gonna be down even more. But it's like that portfolio was down 0.49% yesterday. That's the beauty of having, again, it's like those HODL portfolios, they are not really, there's no real trading in them. Just like 30 juniors or something. And relatively even, I was gonna say, in terms of position size. Some are, the bottom 10 might be actually combined less than one out of the top 3, etc. But that's the beauty of it. So it's like, I don't know how actually people invest. Let's say, if you were kind of all in Tectonic, you were one of the I'm gonna get rich as soon as they have assays. I'm not gonna play the long game. I'm greedy. I'm basically a assay speculator. Obviously, that's gonna suck big time. Line 1 as well. If this was your number 1 pick, etc., that's gonna feel pretty shitty today. Even though, again, we don't know what the future holds. We just know what happened. Everybody was cheering here. In hindsight, what was gonna come after was a total slaughter. But here, at the same time you're celebrating, the flip side of the coin, you should be, have, let's say a lot of dread if you knew that, well, it's gonna go down 75% after this. Then you would probably be more, well, first of all, you would sell, obviously, if you actually knew it. But that's the thing, we never know. But today is gonna, feel sucky, obviously. But my point here is that, and I said this recently, it's like I think you should diversify until you don't really care about any one of the stocks. And because that's gonna make it a lot easier to have patience. Because if there's no stock really that can make your portfolio, it's like there is not one stock where it's like, oh, there's a catalyst coming up, and if that works, that's gonna dictate my whole portfolio. Of course, you're gonna be looking at the tickers all day, every day. But if you have like 2% positions and stuff, even if one high risk, high reward stock, it goes down 50%. Let's say it's not, the case isn't even over, but it's like, Tectonic, for example, they didn't hit a, barn burner hole that could get the market excited in this environment. You would be down 1%, all else equal. That's not a big deal. Do you even care? 1%? Not really. But when this sector, you see in platinum, palladium, whatever, it's like, when the tide comes in, every single one of those stocks, if they're still around, they're probably going to go up hundreds of percent. So you make sure you're going to catch the next wave. And until then, sure, you won't have the terrifying excitement of, I'm all in this stock, and if they hit something, I'm going to be up. But it's like, long-term stress levels are going to be way lower. You're going to be much more comfortable. You're not going to want to jump out a window because one of the stocks, a company did a bad financing or one of the explorers missed. It's like, I mean, yeah, it, kind of sucks. And again, it's like, okay, you have these go down like this. Then comes the thing with volatility. It went down, but it, did it not go down enough? Is it actually overvalued even after the share price decline? Is it an overreaction? Should I be adding? Let's say you have a 2% position. It goes down 50%. All of a sudden, you think it's a much better buy. So you went down to 1%. And maybe you sell something of another stock in your portfolio or add money, whatever. If you sell a stock that's not as cheap, and all of a sudden you have, let's say, 3% in the stock that went down 50%. If that ends up working out, you might make even more money, thanks on that stock at least, from it going down and becoming cheaper than it was actually before the crash. So that means if you thought it was an opportunity before it crashes 50%, it might be a better opportunity. And in that case, again, it's like, is volatility good or bad? I mean, that really depends, especially what you do and of course what the future holds, which nobody knows. We just know that the lower the price, the less chance of success is priced in, and sometimes that's for good reason, etc., etc. Yeah, and as always, it's like there is no. If you listen to Ross Beatty and all of them, it's like and Frank Guster, they're saying like everything is cheap, and there is a whole plethora of companies with like third-party validation, either by prominent investors or by major mining companies. It's like you probably don't know more about these companies or the merits of these companies than these people. I mean, the fresher the better. It's like if you had one junior that had BHP in 5 years ago and they've never participated since. I mean, that's not really saying that, well, BHP likes this. Well, in that case, they kind of don't anymore, at least. It was like Brixton Metals. I mean, BHP participated. They cashed them up again. So obviously BHP still likes Brixton. And it's like, you're not going to be smarter than these guys. I'm not smarter than these guys. They know more about mining and all of that. So if you took 30 names here, for example, you're probably not overpaying for any one of them. And you got 30 shots if you spread them evenly, or 20 or 40 or whatever. When this sector turns around, those will probably not have gone bankrupt, because this suggests that they have good backing and good merit or good access to capital. And if you have 20, even if 5, 6 would go bankrupt, which I doubt, the other ones are going to pay for them, etc., etc. So it's like, you can make, in my opinion, absolutely no-brainer portfolios right now. And if you put them at, like, again, don't go, I was going to say balls deep into any single stock. It's like, yeah, I mean, this is the junior sector, high risk, high reward. It sucks. Oh, negative surprise. Like, yeah, but in the grand scheme of things, like, doesn't hurt that much. And again, you're still in the game for when the tide comes in. And I just added this. I've been looking actually at some producers with dividends, and the funny thing about this one, Endeavour, is that they had a debacle with, like, the CEO was found guilty or something for stealing money or siphoning money. So it's like, I think basically this entire move here is thanks to that. What's the word I'm looking for? Shit, the same. Anyway, so like some drama basically. It's like I don't know. Maybe they're gonna get sued or will get sued or they are suing or yada. So it's like I'm not saying I fully know the story, but it's like this might be one of those cases where it's like the damage wasn't that bad, except for like it was embarrassing, and maybe they lost a bit of money. I don't know, but it's like I think I remember something about $5 million. I mean, this is a company with $3.7 billion, so it's like $5 million. They don't even care really, for they have very low cost. So in that case, I mean, who knows? Maybe this is an opportunity. It's like 22% discount just from an overreaction, let's say. So I mean, I haven't bought this one yet, but I'm actually looking to maybe add some to the hodl folios. For like, okay, they have a growth profile. They're in Africa. They're serious. La Mancha owns like 18% of it or something. And who knows? I mean, we go into a bull market. And they keep growing, yada yada. So there's like, point is that there's so much stuff out there that's good that you don't, and I've said this a bunch of times, like if there was any time you should be diversified, really it's at lows, because in that case you make sure you will capture the tide. Because if you bet everything on one or two companies, especially if they're high risk, high reward, there's a fair chance that, or fair risk, that neither of them will work out, and you will have nothing really to revalue going into the next bull, which might be, who knows, the next bull market might be a 10-year long bull market or something like that. If you want to make sure to be a part of that, you need to make sure you're around and your companies are around, or at least your portfolio overall is around. So yeah, that's it. I thought it was especially prudent because like there's a lot of hoopla around line 1 today. So I haven't fully decided. I mean, I'm probably going to shoot an email, see if there's room in the private placement, and then I got to come up with some money, which means I got to sell something. So I'll see what happens with that. But yeah, so it's like, I mean, we're kind of on standby, I was going to say. We simply have to, it's like, yeah, it's down to 50 cent, right? Yeah, 50 cent. If it works, if they go into production, are able to do it, cash flow positive, this is probably gonna look cheap one day. If they don't, it's gonna go down, and obviously, downside risk is always 100%, while the upside is, I mean, theoretically unlimited. Yeah, so I mean, best case, this is what gets them over the finish line, and they can start production and are able to do it. I mean, in a good manner, and actually start to produce cash flow, and then, I mean, sooner or later you're gonna get into the 500 zone, and that might be, a few really good quarters or maybe years, and there's a lot of exploration potential. So yeah, I mean, the blue sky is basically that it would end up being something like, I mean, even half a K90 obviously would be, or not K92 or whatever it's called, would be great. But there's no guarantees. That's why it's like I'm not all in on any single story. Far from it. I have some big positions, but it's like those are typically the most low risk, and I think I said that in the piece I did, last piece I did on line 1. There's like the most risk averse approach is to buy after they can show that they go into production. Otherwise, you add more risk, obviously, because the rubber's gonna hit the road, and we don't really know how the rubber has hit the road yet. So because I don't 100% know what this financing is for. I mean, are they having problems, or is it just cost overrun, but the financiers got them by the balls because this is the worst environment to raise money in since 2001 or something? I don't know. I just know that the upside is getting more diluted than I had hoped. And yeah, that's about it. It's like in a year or two, we'll find out if this was cheap in hindsight. Consider me biased. I own shares in, I think, almost every company I mentioned. Well, especially the juniors, and some of them are banner sponsors as well. Make up your own mind. Stay, rational, calm, collected. Try to use volatility. I mean, like you probably know by now, there's like probably less than 5% beat an index over the long term. I think it's even lower in this environment. So just to be clear, 100% of opinions you hear, of the opinions you will hear about anything when it comes to investing, there's no chance that all of 100% of opinions comes from someone who knows how to make money over the long term in this sector. And with that said, it doesn't mean that like everyone is intentionally, tries to lead people astray or anything like that. But that's just the reality. I mean, people get emotional. That's why most end up with lackluster long-term returns. Yeah, so that's it. Thanks for listening. Bye.